The S&P finished up the week on a pretty flat note, but quite the strong week and quite really the strong 7 week period. Now the question is, after such a strong 6 week rally, to finish up a seventh week as strong as we did, did that produce more of the same kind of exhaustion washout signals that we saw on Wednesday's market outlook video? So I'm going to break that down in tonight's video. We're going to take a look at what's driving a lot of this price action this week in particular, and how the market initially responded to the FOMC meeting, like we talked about on Wednesday, with kind of a safety trade, like a real surge in the safety trade. Though from a risk, I mean, obviously everything else rallied too, but the things that rallied the most of the everything rally were safety trades. Even the dollar, which was a decliner, the foreign currency that's most considered a safety currency was the one that beat the dollar the most. So we're going to take a look at then now 2 days later, how has the market reacted, and does it continue with that safety, and what does it look like from a bigger picture, especially how does this return over this past 7 weeks compare to the pullback that we had previously off of that August peak. So we'll put a lot of this move in the context here, and then we'll take a look at a trade that had its own decline, a little bit more of weakness over the past couple of days, mainly because of earnings than what the market did. And we'll talk about how to trade a potential bounce, but then how to protect ourselves in case it continues with this decline into more of a reversal. So let's go ahead and get started. Today is Friday, December the 15th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video and some of these other posts down here on the bottom. Come here and click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. There's a post there. Usually you can hit that like button. I don't know why it's not loading up. If you come over here, again, it's a big deal for us. That's why we always ask for it. It helps get our content out to all of our followers on those platforms. Our goal is to get to 100 likes on Twitter. So for those who do like this day in and day out, thank you very much. For those who don't, you can do it right now with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we second straight expiration cycle that we've really rallied into the close. Pretty significant rally into both those closes. In fact, if you look at it, if you look at the market forecast in this way, like as a monthly chart, but into options expiration, you can see that here again, second straight month. And this month wasn't as big of a range as what we had last month. The second straight month that we've rallied into a close. Last time we had a 4-month streak there throughout the early part of this year, coming off of the banking crisis. And then, of course, we had a 2-month streak over here. So short-term sentiment's the strongest it's been in a very, very long time. Both lines finishing above the 95th percentile on the monthly chart. So very strong move into the close, and little tiny weakness, not very much at all, on a daily basis. So it brought the momentum line down. Technically, this would be an intermediate confirmation signal with an oversold momentum line that's barely oversold, and a strong bullish posture that's about as strong as, it's 98th percentile. But the near-term line is still in the reversal zone, so it's not the perfect bullish intermediate confirmation signal, which would suggest that this is a buy the dip signal. Obviously not very much of a dip there to buy. We didn't have very much of a dip here to buy either on some of these where we dipped. The momentum line dipped and we rallied off of that one. But the near-term line was in the reversal zone, at least in bearish territory there. We also rallied off of that small little dip for like a day or two. Well, actually a few days. Again, the near-term line did get into bearish territory there too, and we rallied. There was a small buy the dip there too, and the near-term line was kind of similar to where it's at right now. Of course, that was when this intermediate posture just started being bullish, and we've been bullish now for a while. So that's the S&P 500. Of course, the NASDAQ looks very similar. The near-term line is down a little bit lower. The momentum line is not in the reversal zone, but still very strong bullish posture. Your Russell 2000 is what's been really killing it the past couple of days. You can see the big cluster we had the last 2 days. Obviously not a cluster today, but again, another buy the dip signal. Bullish intermediate confirmation signal. We are 9% above 30-day moving average, so it is a little extreme, bigger than what we have seen. So I don't think this is your typical buy the dip signal. Again, considering how far up we are, and considering how extreme the last 2 days were when we really broke out after the FOMC meeting here. And of course, finally, your Dow Jones Industrial Average. When you take a look at it, it also kind of broke out after the FOMC and just kind of stayed higher. Very similar pattern, not oversold on the momentum line, but it is in bearish territory. Very strong intermediate posture coming off of a cluster from earlier in the week, and we're still pretty bullish here. Again, going into second time that we've kind of rallied a significant amount going into options expiration. We'll see if that, if we can we get 3 options expirations in a row, going through basically the Santa Claus rally, going through into January. We'll see if that ends up being the case. You can see last January expiration, we were kind of up and down going into that expiration cycle before we were down in February and then down into March expiration. So we'll see how this plays out considering how the strong bullish trend that we're currently on. Let's take a quick look at the weekly chart. But let's go to the Russell. You can see the Dow getting up to new all-time highs. The Russell obviously is not getting up to new all-time highs, but it did cross over the market sentiment line a couple weeks ago. You got dark green shading the green line now. We're not up to new highs yet here, but that's one of your biggest weekly moves we had. We're 8% above the 30-week moving average, which is a pretty high level. Pretty much the peak here in the past couple of years. It's obviously not the peak going into like 2021, but a pretty strong level. Again, nowhere near those highs. Again, your Dow Jones Industrial Average it actually looks pretty similar to what we saw from the Russell just earlier in 2021, where you get a pretty decent move already, and then you in one fell swoop you break through. Kind of looks like what you saw here with the Russell. When we're pretty bullish, and then you had one, it looked like we're breaking out, and then it ended up being a fake out pattern. So we need to, that's a good move on the S&P. It's pretty unique to the S&P. The Dow. The S&P did not break through its highs after again a parabolic move, and then we wash out this week. We talked about that in Wednesday's market outlook. All the washout patterns, exhaustion type patterns that we saw. So that's what the S&P looks like. And then the NASDAQ 100, the NASDAQ 100 here, you can see actually got a cluster this week on its market forecast pattern. Again, not at new highs yet. I think it is a new closing high. Yes, it is a new closing weekly high, but it's just not, we haven't breached up to a new intra-week high. But you can see again, cluster, second cluster we got a cluster when this trend started. We got the bull tag and bounce, and now we got a cluster here. Again, up 10%. Higher high already, even though obviously we're not going to, I would doubt we're going to get to a higher high above the moving average, considering how significant that move was. That was the parabolic move on the NASDAQ earlier in the year, in the summertime, and then of course this is kind of the Russell's turn to go parabolic this week. Let's take a look at the other weekly chart. Again, when you look at the S&P 500 here, very strong candle. I've actually got a couple studies here. This is the Hakinyashi differential that we just saw, but it relates it to, so it normalizes it. So I can look at it. A regular differential gets bigger as the price gets bigger, but you can see we got a really strong candle this week above this, almost at 2.5%. You can kind of see it's a pretty big candle, relatively speaking. But what adds to it is the fact that the shadow above it's pretty big too. That's a pretty decent sized shadow that generally you don't like to see at the end of a bullish candle. You can see the Russell 2000 here. Let me zoom in. The Russell 2000 did the same thing. Got a very big candle. You can see its candle is bigger than, about as big as what we saw over here. But if you notice the size of that upper shadow, if you follow my cursor out to the right, is a lot smaller back then than it is now. Getting these kind of size candles, for example, like this one here on the upside, or like this one over here, another bullish candle with a long upper shadow, big candle up here at the top, big shadow. That ends up being another exhaustion type pattern. So it's a golden cross, the 10 weeks crossing over the 40 week, and we already had some really good sized candles here, as you can see, but we've gone really extreme on this week's candle. That's a huge size of the candle, and it's a big upper shadow, which means like we kind of moved really fast too fast in order to bring the average up. The Hakinyashi close is an average of the open, high, low, and close. That's very exhaustion pattern-ish when you look at that. The Dow Jones Industrial Average is pretty similar. Again, you can see the size of the candle is pretty big. It's one thing to have a big candle when you're starting a bullish move, but when you've already been on a move and you get kind of, you start kind of going down a little bit, then you finish with a big one and a big shadow. Again, it tends to be kind of from an exhaustion standpoint. You can get these big shadows like on transitions. You can get these kind of big shadows as well when you're on bearish things, but it's when you get the bullish candles and you get the big shadows, like, kind of in some of these other ranges like this one here, then that tends to not be so. It tends again to be more exhaustion oriented, and that's kind of what I'm seeing here. The size of this candle, the shadow on top of the size of the body, is pretty significant in my opinion. Let's take a look at the green arrows charts, and you can see obviously we have 3 green arrows across the board. In fact, when you look at the weekly version of this, we have 3 green arrows on the weekly chart as well. Obviously you're above all these moving averages, which is a good sign. You're above the 8, 17. You are in convergence mode. Like, there's a pretty decent divergence forming here. Obviously a lower high on that MACD, much higher high on the index itself. That's the divergence. There's kind of a similar type of divergence, lower highs with much higher highs. So you would expect that we're probably going to come down. I mean, obviously we're going to come down at some point. This is a cyclical oscillator. But you can see how we're getting some strong volume. We got some strong volume yesterday on an up day, and we had some strong volume today. But again, you typically get these arrows when we're falling, not when we're rising. Again, another exhaustion type signal that we see there. Of course, the DMI is extreme. This is one of the extreme levels that you'll see. The negative indicator is still below 10 despite the little jump up. We're still above 40 barely, but the ADX is still climbing. Again, one of your bigger parabolic moves. Again, probably the biggest parabolic move that we've seen since that early 2018 run right here when you got up into the low 50s in the ADX. So outside of that, this is a pretty decent parabolic. Remember, parabolic moves don't consolidate sideways, especially when you get all these. And that's the regular. I mean, that is the regular DMI. If you look at the short-term DMI, it's out of the park. I mean, look at that. We're up in the 70s. Again, it kind of brings to mind that parabolic move, also that 2018 parabolic move. We've been below 10 for a very, very long time on this one. Very extreme on that. It can be, we can stay parabolic for longer than you expect. But just remember, it doesn't, once you are parabolic, once we do consolidate, it usually does consolidate sideways, especially the longer that you stay parabolic, right? That kind of makes sense. The whole moving average, you can see we're way above the 200-day in the 87th percentile. We got a transition after getting a big old Hakinyashi differential here, and you can kind of see if I were to throw on that where I normalize, you can kind of see the difference when I normalize that Hakinyashi differential. So here's the normalized version of it. If I were to zoom out, because the values of the index gets bigger, so that you see how we're a lot more volatile than we were over here when the values were smaller. You get a lot more volatile as they get bigger. well, not necessarily here, right? This is normalized, but still, regardless, you can see this is another pretty significant Hakinyashi candle here, bigger than what you normally see. You can see if I just put it on this peak, one of your bigger ones of the past year, and if I were to go out the last couple of years, you can get the correction there. Still one of your bigger one that you'll see, but again, it was already, we were already on a bullish move. The whole is still, we haven't had the down period, right? We haven't rotated to the downside. The parabolic SARs only rotated for a couple of days, so this is pretty much all still one big move, and you got another big Hakinyashi spike with a transition candle already today. If you look at the RSI and the CCI, again, they went pretty parabolic. In fact, we almost had a very, very rare pattern where the RSI closes above 80, the CCI closed above 200 on the same day. That didn't happen. We ended up only closing at 79. We closed at just below 79. We're back. We're still above 150, but back below 200. So we ended up not getting that rare pattern. We were so close when we were at the highs of the day. But now again, being close to 80 is being above 70 is parabolic, much less being at 80. So very, very strong move on the RSI. And then finally, the Bollinger Bands, we saw how big that bandwidth got on an upward move, which is pretty rare to get a new 150-day high point on the bandwidth on a bullish move. Usually you get these big spikes in all the space, and obviously that wasn't the case this go around. And also you were so extremely above the upper band. Now you're below the upper band, but still in the 97th percentile, and you're still above the Keltner channel, easily above the Keltner channel to an extreme. We were very extreme the last couple of days, as the bands are still outside of the Keltner. So there's a lot of extreme patterns here showing up, and we're just starting to resolve some of them. And I think especially now that expiration's done, it'll be interesting to see if we end up coming into this gap of volume over the next few days, because we moved up so fast post FOMC that there's a big gap. There's no support below us because we moved up so fast. So it makes it easy to go. It doesn't mean we have to go down. It just makes it easy to go down. Remember, we start looking for a reversal once the green line gets below 70, which means this high tag has got to move over here. So we have to go 6 days without a new high. Then that gets the green line below 70. That makes you more likely for the red line to hit above. And you can see, like right now, the red line, which is the low, is going to be, by the end of this week, it's going to kind of be in this area right there. So it's going to basically be at last week's low point. So if by the end of the week, if we don't have a new high point and we're flirting down in this area by the end of the week, then you can see how we'd be more susceptible to that reversal pattern on the Arun indicator. I mentioned that the volume was so significant. It was even more significant today. 141 million shares. Again, you can see just because there's options expiration doesn't mean you get a bunch of volume. As you can see, that one didn't get above average volume, and this day is a down day. It got above average, but not 1.5 times, and so on. So that doesn't mean we have to get it. So it was a really, again, a washout type move. 141 million shares, but very small volume, only less than 3.25 points, so less than the ATR. So when you look at it on this chart here, you can see the ATR is not really rising. It's already extremely low, but the volume is starting to pick up a little bit, which makes you wonder, again, when this goes up, it's usually bearish, not bullish. So we'll see if that ends up continuing to be the case, as over the last few days, volatility has actually picked up. It's at an extreme low. It actually finished down on Friday, but it's at an extreme low near the 80% mark relative to the VXV. And you can see the VVIX jumped up big. So even though the VIX didn't jump up, the VVIX, which was extremely low here in the low 80s, jumped up to 88. And now you can see, obviously, because of that, the correlation turning back down. So the VVIX might be already anticipating kind of what we're talking about, a little bit of an increase in volatility from these extreme lows now that we are through options expiration. All right, now let's take a look at what's driving this price action. Again, you can see the 3-month charts, the QQQ world and commodities really on the other end of the spectrum. But let's just take a look at what happened here today. So we'll come over here to December, and we'll take a look at just today alone, and then we'll look at the week. But this is how we finished the day. The dollar was up, right? Remember, the dollar's been down for a good chunk of this rally. The Qs were up, so it didn't put a lot of pressure on that. It did put pressure on IWM. They've been more sensitive to the dollar moves here lately. Obviously put some pressure on high yield relative to long-term treasuries at least. And you can see international stocks, not surprising, dropping, and gold dropping. That's just kind of a one-day phenomenon, because if you look at the rest of the week, that was not the case. The dollar was actually down, really significantly going into today. And of course, IWM benefited the most because of that. And it really is coming out of the FOMC meeting is where a lot of that weakness came from. And then yesterday. But IWM benefited the most. Real estate benefited quite a bit. Long-term bonds rallied significantly here. In fact, post-FOMC, it was kind of interesting that it was very much a safety trade. We talked about that on Wednesday's market outlook. Gold and everything but the dollar that was safety-oriented. Japanese yen, in fact, was the biggest winner against the dollar, and that's their kind of safety trade in the currency world. You can see commodities lagged with gold. Despite the weakness in the dollar, they lagged equity prices there. And again, 5.5% gain on IWM is a pretty decent gain, again, over that past. But if I were to go back to where this all started, to the 27th is the lowest point, you can see here the returns. From that point, you can see the IWM was kind of doing pretty well to begin with before this FOMC meeting, but then exploded up to a 21% gain. QQQ is up 8. I mean, these are good annualized gains. This is just over November and half of December. So this is like a month and a half, and you've gotten good returns. If I were to go back to the previous peak, so we had peaked on July 31st. So if I were to go back to, say, August the 1st going forward, then you can see here that the IWM is just getting back to break even from that August 1st, July 31st peak. The Qs are up 5.5%. They crossed that threshold a couple of weeks ago, and you can see TLT now, which was a big loser during a lot of that weakness. TLT IWM was down 18% at one point. You can see the big catch-up trade IWM had this week just to catch up to where some of the other indexes were. The dollar was so strong. It's actually still pretty strong. You would think, man, the dollar must have really come down back past its break-even levels to get these equities that were down 18% to be back to their own break-even levels. And that obviously is not the case. And commodities, which are relatively bullish, they're actually more bearish. And then, like I said, bond yields, which were so bullish, they're almost back to where they were when this whole correction, the pullback, deep pullback for the S&P at least, correction for the Russell, but deep pullback for the S&P when the whole thing started. If I take a look at, let's take a look at some of their individual charts. So give me a second to pull up. Remember, the dollar had such a bearish run this week. That's its run, and then you can see the Harami pattern that kind of formed there on Friday. And the big time divergent pattern developing there. If you take a look at its RSI and the CCI patterns, you can see also a divergent pattern after being below 30 on this first low point, and then now to get a divergent low point, a lower low with a higher low in the oscillator on the MACD as well, suggests that maybe this was too low on this one. So again, if this starts to rally, if bond yields, kind of bottom out here after such an extreme low. I mean, its RSI is below 30 now, which is obviously not very common. And we never did get, we kind of did in 2021. Obviously got way low in 2020 during COVID, but this is a pretty extreme low coming off of an RSI that was above 70 there in September, right, going into the beginning of October when you were hitting that 5% mark. So big dramatic reversal to the downside on TNX, and you saw the dollar, right? But you take a look at commodity prices, they had also been pretty extremely low and also appear to be trying to figure out a bottom here too. And so that's the kind of the strength of the rally, is weakness in commodities, weakness in the dollar, and weakness in yield, strength in TLT for that matter, which you can see got up to its own extreme level, with the divergent pattern forming and getting up to these old low points potentially as a resistance level. Then you have to wonder, is the market losing the fuel for this rally in the form of that weak dollar, weak strong bonds, and weak commodity prices. Let's take a look at the sector rotation. So give me 1 second to pull up the sector moves here. You can see over the last 3 months, technology has been the big performer. But let's look at today first, and then we'll take a look at the week. So here's, again, discretionary, technology, best performer. On the other end, utilities and real estate giving back some of the gains they had yesterday. If I were to take a look at the week that was, of course, they were such big winners post FOMC. And then if you can see utilities giving all of those gains back that it had. Real estate holding a lot of its gains, but utilities giving all of it back. Staples were doing pretty well too. They started to underperform. Healthcare too. Communication services have lagged all week. Technology has been able to outperform to a small degree, but it's mainly been materials, industrials, financials that have been your big winner. Energy was a loser, but it benefited coming out of that FOMC meeting. Again, going all the way back to when this whole thing started, October 27th. You can see that real estate has been your big winner even before the FOMC meeting. Technology, discretionary, been up here too with financials and industrials. Energy has been flat, and your safe haven areas lagging behind. Not surprising in a bullish market. Let's go back to the last peak, and when that started, and you can see, okay, technology is above its break even. Energy has been very volatile, but is down. Utilities and staples have been your biggest losers from peak to current levels, as the S&P has crossed that level because of financials, which is interesting. And financials doesn't necessarily benefit in a falling yield environment, or especially in an inverted yield curve environment. And yet they had a really good run this past week, kind of an oversold technical bounce. But really, really good run to come off of some pretty significant lows. Discretionary as well, making a run. And of course, real estate was your biggest loser at the lows. Utilities at one point, real estate at another point, before now being one of your big winners here. All right, so our trade idea of the night's on Adobe. If you take a look at Adobe, we had a nice little pullback itself over the past couple of days. It's got a bull tag, which can be a reversal sign, start of a bearish trend, or it can be a bounce signal. Considering the market trend right now, considering how oversold this little drop has been, you have an indication that this could be a bounce signal. The intermediate line is out of the reversal zone, so it's not a bullish intermediate confirmation signal, and it's still slightly above its market sentiment. So we'll see if we can bounce out of this or not, if it turns into something more. We'll talk about how to trade that possibility here. Let's take a look at its weekly chart, and you can see, okay, we've been pretty bullish. We have a couple transition candles here coming off of earnings. The PPO has been relatively strong at a pretty decently high level. Looking at the 3 green arrow chart, you'll notice, again, we're sitting right on the 50-day moving average. So pretty decent support there. Lots of volume around this earnings. MACD is sitting right at negative levels, middle of the chart, just barely out of bullish range for the stochastics down there. Looking at the DMI, you can see the pullback here as well, but not a trend-changing pullback, right? The negative indicator's up above 25, but the positive didn't drop below 20, so it hasn't necessarily changed the trend there. If you look at the RSI and the CCI, very similar. They're not bullish levels, but they're not bearish levels either. We didn't drop below that minus 150, minus 200 level. We're definitely still above 40 pretty easily there. Looking at the Ichimoku cloud, you can see that we had a bullish trend. Obviously, that bullish trend ended, but we don't have a bearish trend going. And then finally, from a Bollinger Band standpoint, you can see that we were above the upper band, then we dropped all the way down, did not get below the lower band, nor the lower Keltner channel. But you can see we kind of started the bearish move, though the bands are still inside the Keltner channel. So we'll see if we bounce right back up inside of this range, just like we came back down after being outside the upper band and the Keltner channel. Kind of a breakout pattern there, and then a failure coming into this earnings, of course, being the big catalyst there. So what I decided to do here on this trade was, okay, let's look at doing a bullish trade considering the bounce signal that we have here. Looks like I'm not getting the prices loaded up. Slowly but surely loading up, but we'll at least take a look at it here. And let's just start with the bullish trade first. So we will look at the 575, 570 bull put spread. And you can see I'm risking about a normal position size to get a pretty decent return. This was a 40 delta when I sold it, so relatively more aggressive than normal, more return than normal if we end up getting that. If it stays right above these lows and bounces. But if it doesn't and starts to go on the downside, I've got a very low risk, but a pretty decent reward, more than a 3-to-1 reward to risk ratio with a very small risk. So the idea being that if we do bounce up, then I'm willing to take $100 because I'm getting more reward on that bull put spread than normal. So I'm willing to give up for a normal position size here. I'm willing to give up $100, $180. They get down to like say 400, 350 to 400. I'm willing to get down to that with that, knowing that if this does turn into a trend reversal, then I've got a good reward to risk ratio on the downside that I'll take a little bit of a loss on this trade and offset that with a much bigger reward on that 3-to-1, 3+to-1 reward to risk ratio. So kind of protecting myself just in case to the downside, but expecting the higher probability bullish trade to work out, assuming this bull tag and all these signals kind of come off of their bullish low points and bounce back up to new highs. Alright, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up in a new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Friday evening, everybody, and we'll see you all next time.